Hey YouTube, it's Matt Fairclough. I'm here with one of my good friends, Andrew Cushman. What's up, man?
Hey, doing all right?
All right, good. So Andrew is I'm going to use like real estate lingo, but he's going to tell us what that is. He's a syndicator of apartment building projects. So first of all, what does that mean, man?
Well, that's a good question. Basically, you know how if you put your money in the bank, you can't get jack squat for it right now?
Unfortunately, yeah.
Yeah, so that's a common problem with a lot of people. So what I do is I solve that by putting together an apartment deal, and let's say we need $1 million. I'll say, hey, I'll bring it out to the people I know, the investors I know, and say, look, if you invest $100,000 in this deal, and you'll get X% return. So let me know if you want to invest, and we'll make it happen.
And they'll own a chunk of the building alongside the other investors and yourself, right?
Yeah, exactly. So they own shares in the LLC, which entitles them to a portion of that property and all the profits that go along with that.
Yeah. So I understand syndications that it's a great way for investors that have cash to control and be a part of larger projects that they might not have all the money to take down by themselves. They can be a part of bigger things that could be more profitable than the stuff that they can buy with their own money, right?
So, yeah, definitely.
Yeah. So when you're now you've done several. How many of these syndication type of projects have you done?
I've done 12 syndications for a total of 1,566 units.
Great, cool.
Yeah.
So you've evaluated a lot of apartment buildings in your time,
Thousands
right?
of them, yes.
Thousands of them, right. So when you're looking at an apartment building, what are like the three things that you look at first when you're looking at an apartment building?
Sure. I mean, big picture, I'm looking at the asset itself. You know, what am I buying it at a good enough price that I have a nice low basis, and I want it to be able to support good debt. I buy it right, finance it right, and then I want it to be not only in a good market overall, and when I say good, I mean a market where you have jobs coming in, people coming in, you're going to see growth, and then ideally that growth is diversified in what's driving it. It's not reliant on a single thing like oil or you know, one or a big plant that could shut down and empty out the town.
They're buying the one-horse town.
Yeah, you don't want to buy a one-horse town.
Yeah.
So, and then also within that market, how well located is the property? You know, ideally, you know, I'm buying a property that is surrounded by nicer, higher-end properties that are charging a lot more rent. So I can go in, get a good deal on the property, clean it up, raise the rents, and now my overall basis is really low, and I'm in a growing area.
Do you buy buildings that need a ton of, like I've seen deals that are like 50% occupied. Like I looked at one that was half the building was on fire. It had a major fire, right? And so it was a burnout. Some of the people were still living in the sections that weren't damaged by the fire and stuff like that. So somebody's gonna have to come in and really roll their sleeves up. Is that a kind of deal you would do?
Yeah, good luck with your insurance.
Right? Yeah, no, salute. Right?
No, you know, I've done those deals and I won't do them again. You know, the most challenging I did, I bought a property that was 75% vacant. You know, you drive through it and the doors are just open. You know, it's like it's really scary. And you know, and it was profitable.
Ghost town, right?
Yeah, it was profitable, and there are guys that do well with that. But what I found is the, you know, as David Osborne would say, the juice isn't worth the squeeze. Meaning, you got to put so much effort into that to get the good return. I found it's better off, where I'm better off, and there's less risk in moving up the ladder to like a C+ to a B, where there's still room to bring it up and to improve it, but you're not getting phone calls about the the newest drug lord that moved in, or the newest shooting, or you know, the person who had a flat tire, so now they can't pay rent, and you've got to evict them. You just don't have to deal with that kind of stuff.
Right.
So
and he abandoned the car in the parking lot of the building.
Yeah,
he abandoned his oil in the parking lot.
So I don't do those anymore. And anyone doing their first apartment building, I would not recommend going that route by any means.
It may be tempting, guys,
because
the price is going to be fantastic. But I can promise you, there are things you're not thinking about that are going to be in deals like that. There's just it's hard to evaluate or to predict the entire thing. So I would recommend not your first, second, third, fourth, or fifth deal. There's plenty of people that make a lot of money repositioning, major repositionings of apartment buildings like that. But it takes a certain niche. It takes a lot of boots on the ground in the property, and it takes a really strong market knowledge of what it is you're looking at. So not deals like that. So any other things that you look at when you're considering a deal? What else do you look at?
You know, for me, I'm looking at size. I look at the size of the property. I want 90 units on up. The reason being, properties that are smaller than that don't efficiently or economically support full-time staff. And where you really get into trouble with any kind of rental property is if it's under or mismanaged. And so a property that's about 90 units and bigger can afford to have a full-time manager and a full-time maintenance person, and that a good maintenance guy saves you a lot of money, by the way, a lot of money. It can afford to have those people on site all the time, and a lot of times they'll even live there. And so that property will be managed far better than one where you've got a manager who maybe manages 3 different properties, and they're all 20 units, and they're dancing around and
going to who's screaming the loudest.
Yeah, they just go to who screams the loudest. So that's why I do that.
Do you give the on-site maintenance guy, do you give him a free or discounted unit, or do you consider that part of his compensation?
It depends on the market. So on some of them, they just get a good salary, and they either live off-site or there's no discount. And on some of them, they're getting 50% off. It depends on the market.
Okay, cool. Great. So for those of you folks that want to learn more about Andrew or just want to hear the stuff he's up to, maybe join your mailing list if you've got one or something like that, how do they get a hold of you?
Vantage Point Acquisitions is the name of my company. The website is just vpacq.com. If you want to reach out, just submit a contact form there. I do always reply to those emails. If I'm traveling, it might be a couple days, but I will get back to you. And then, of course, I'm on BiggerPockets and LinkedIn as well.
So. vpacq.com.
Yeah, VictorPaulACQ.com.
Cool. And they can join a mailing list or just, submit a contact request and talk to you.
Yeah, exactly. Okay, cool. And if anyone who's interested in possible investment, we need to make sure we're a good fit for each other. So we'll send you a short form. You fill that out. And if we if we were both a good fit, then we'll add you to the mailing list, and then you can at least see deals. So.
Oh, great. Awesome. Thank you so much for your time.
Hey,
great conversation. Thank you guys for watching, and have a great and profitable week.